Shares of Netflix plunged 10% after its last quarter earnings, and the company is about to face its biggest competition yet for streaming. In this video, I'm doing a complete analysis on the stock price, why I think shares could rebound 25% from here, but why you still might not want to invest. We're talking investing in Netflix today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, to be honest, I've always had kind of a love-hate perspective on Netflix. Okay, on the one hand, the company is an undisputed leader and a pioneer in streaming. Netflix was streaming before streaming was the thing, and it's reinvented entertainment. And the return on Netflix stock has been unbeatable. In fact, none of the other FANG stocks, that's Facebook, Apple, and Google, none of these other stocks even come close to matching that 420% return on Netflix over the last 5 years. But as a value investor, as a dividend investor, I've always been skeptical of Netflix as an investment. Even after that big sell-off last month, shares are still priced at 122 times the company's earnings. Now compare that against a PE ratio of just 16 times for Disney, or an average of around 18 times for peers in that entertainment space. Basically, investors are saying that the future earnings out of Netflix are going to be worth 7 times what Disney's future earnings will be, all while Disney just produced the top grossing film of all time. And while Netflix has continued to grow their revenue, it spends more than 3/4 of that on the content. Now this is something that we'll look at more because it's the single biggest issue for Netflix, but that cash that it burns to produce content leaves the company little left for profits. The company spent over $13 billion last year producing that content, more than 80% of the $15.8 billion that it made in the year. The trend in that spending is increasing, and as an investor, you have to wonder if it's ever going to be able to get those production costs down. It's hard to argue against the success in the shares, and that 15% sell-off after last quarter's earnings may just be enough to get even a skeptic like me into the stock. So let's work through a Netflix stock analysis. I'll cover the expectations on earnings, the biggest factors driving the stock price, and then we'll look at some analyst estimates over the next year. Now, looking back at the company's price to earnings ratio, and we see something absolutely typical for a growth stock, a ridiculously high PE ratio that is slowly trending down over the years. Here around 200 times earnings in 2017, touching a low of around 100 times late last year, but around 150 times multiple for most of this year. And this is the big hangup for investors in growth stocks. How do you justify paying 100 plus times a company's earnings when you can get a competitor's shares for just a fraction of that valuation? If you do invest, you've got another problem when you work with growth stocks. That PE ratio will trend towards the industry average over time. A company just can't double its sales every year. It's going to be bigger than the economy in short order. So as growth slows, investors are going to start paying less for those future earnings. Now we saw that with Netflix. The investors were paying upwards of 300 times its earnings in 2016, but are now only willing to pay really about half that. So you need that confidence that in the future, even if investors aren't willing to pay those sky-high price to earnings multiples, that earnings is going to have to increase enough that you can still make money when you sell the stock. It makes my job as an analyst a hell of a lot harder as well. I can estimate a company's sales and earnings out maybe a year or two, but not knowing how much investors are going to be willing to pay for those shares, it's almost impossible. Will the PE ratio still be at around 150 times earnings, or is maybe something like 75 times earnings a better benchmark? I need to know that to make that target price on my earnings forecast. Now we see here that analysts are expecting Netflix to report earnings of about $4.80 a share over the next 4 quarters. That's an increase of 88% over the $2.55 per share reported over the last 4 quarters, and there's a good chance they'll meet or even beat those expectations. Even in this most recent quarter where subscriber additions disappointed, the company beat earnings estimates. Now sales are expected just 28% higher to $22.6 billion over the next 4 quarters, and this is where we really start to see a problem in the numbers. If Wall Street expects Netflix to grow earnings by 88%, but to only make 28% more in revenue, it's saying that the company is going to become more profitable. In fact, to get these numbers to work out, Netflix has to go from a profit margin of 6% to one of 9% in 1 year, which is absolutely a huge accomplishment when you're also trying to keep up that pace of growth. But let's look into some of the recent headlines and then the business itself to see if we think the company can reach those numbers and what a fair price for the stock should be. Now, probably the biggest metric for Netflix is that net adds, the increase in paid subscribers the company reports each quarter. Now you can take a fairly average revenue per user against this and get a good idea of how much the company is going to make in any given quarter. And that was the big bad news when the company reported second quarter numbers last month. Netflix reported adding just 2.7 million subscribers versus expectations that it would add 5 million subscribers. Now you see here that not only did the company miss expectations, but the subscriber adds for the quarter were way below even the previous quarter was. International subscriber adds hadn't been so low for 3 years, and the company actually lost 100,000 subscribers in the United States. Now shares of Netflix were already off their recent highs, but plunged 10% on the news and are now down 18% off that 52-week high. But take a look at this graphic put out by the company and you'll start to see why I think we could be in for at least a short-term bounce in the shares. What we're looking at here is the forecasted net adds, the gray triangles, and then the actual reported subscriber adds in green or red for each of the last 14 quarters. Netflix has missed the forecasted number once a year in each of the last 3, only to turn around and beat the forecast in the next few quarters. That second quarter of the year is usually weaker on content, and in fact you see that 3 out of the 4 misses here were in that second quarter of the year, and management pointed to that weak slate of new releases in the quarter. The 3rd season of Stranger Things released in the 3rd quarter in July, and the second half includes some major exclusives from heavy hitters like Martin Scorsese, Michael Bay, and the final season of Orange is the New Black, which could be a huge draw for subscribers. Now, the one bright spot in the second quarter report was that even as subscriber adds missed forecasts by more than 2 million subs, the company still managed to meet expectations for revenue and its earnings. It did this on a 10% increase in prices. So while the company didn't add as many subscribers during the quarter, it was still able to make more off existing subscribers to offset that difference. What I think you see over the rest of the year, though, and we'll get to my specific price target later, is subscriber growth coming back in the last 2 quarters of the year, plus that higher price point, which should help the company report blockbuster sales and earnings. Now, this is all great for short-term investors that can bag maybe a solid return over the rest of the year, but the picture changes completely for those longer-term investors. Over the next 12 months, Disney, Apple, Warner Media, and NBC are all going to be launching their own streaming channels. Right now, Netflix has a commanding share of the global video streaming traffic, but how does that change when Goliaths like Disney and Apple get in the game? Apple is spending $1 billion just on initial programming, including signing stars like Jennifer Aniston, Steve Carell, and Captain America himself, Chris Evans. Of course, the big question mark is how much damage Disney's going to do with its $7 a month service and a lineup of original content on top of that massive library of films. And Netflix has already released that it's going to be losing 2 of its most popular shows, The Office and Friends, to other streaming services later in the year. Now, if we dig back into the numbers, and I know this gets a little complicated, but it's really the depth of analysis you need to be doing if you're going to be investing in individual stocks. So Netflix booked just $270 million in profits last quarter on $4.9 billion in revenue. Now that means the company converted about 5.5% of its sales into earnings after all these expenses. That top-line revenue number is growing, but it's already seeing slower subscriber growth and competition from these other streaming services is going to make those price increases much harder to push through in the future. So meeting those big expectations in earnings growth needs to come down to profitability. That profit margin of 5.5% needs to come up closer to something like Disney's that converts 21% of its revenue into earnings. That could be extremely difficult considering how much Netflix pays for its content alone. Then you've got all these other marketing and other costs as well. So let's put all this together though and look at some of the analyst price targets. First though, if you're liking the video, do me a favor and tap that thumbs up button below. More than 30 analysts cover shares of Netflix with estimates ranging from $515 a share by Jeffrey Waterslack of Pivotal Research. That's a 65% upside to the current price. To Michael Pachter at Wedbush with a low target of $188 a share or a 39% downside from here. Despite that low target, most of the analysts are grouped right around that $400 a share target, so a 26% upside to the stock at this point. For my part, I do think the shares can rebound over the rest of the year. The company still has a strong lineup, and we still have a few months before that competition really starts heating up. Netflix is making a strong push into India with a mobile-only service, and I think subscriber adds for the rest of the year could really surprise to the upside. So maybe you see that bounce back up to that 400 price target towards the end of the year, but the likelihood of more disappointing quarters just increases after 2019. We'll start seeing a lot more competition for subscribers and pricing pressure. Content is only getting more expensive to produce, so I think Netflix has a hard time getting to that profitability that investors are going to expect over the next few years. Don't miss my analysis and shares of Apple and Ford by clicking on the videos to the right here, one of which could produce a 25% upside. Join the Let's Talk Money community by tapping that subscribe button and the bell notification.